Hi, Matt McAleer, President, Director of Private Wealth, Cumberland Advisors, with the Moose, our Chief Investment Officer. Couple weeks now into the new year, Moose, and I heard you say earlier you feel like you were catapulted into 2026.
It's unbelievable. You come out of the holidays, you think, start out slow, boom. And, our president hasn't, slowed that down any bit, right?
Yeah, there's been plenty of news.
We got Venezuela, we got going after Jay Powell, we got all sorts of stuff.
Yeah. On the equity side, similar. If you look at the indices, well, they're kind of flattish. S&P's up 1.5% year to date. NASDAQ up 1.25%. Where the real action is, and this is a point for today's conversation, brief conversation, is when does a reversion to the mean trade actually become a forward-looking trend? And where I'm focused on is small and mid cap, John,
right,
versus the S&P and the NASDAQ. I don't have to reiterate that over the last 3, 5, 7, 10 years, large cap growth was where you had to be, where you had to be to perform. Any kind of diversification was a draw or a drag on performance. Right. But now we're at a scenario that the 1 month, the 3 month, and the 6 month have outperformance from small and mid versus the S&P.
Every dog has its day.
Right? So what we are focused on is, again, is that a long in the tooth reversion to the mean, or do we have some breakout? On some of our relative strength charts that we look at, we have seen reversals up. Reversals up mean sustained strength. We try to ignore short-term blips from size and style. For example, small, mid, large, value, growth. We try to ignore 1, 2, 3 week moves. 1 month gets our attention. Maybe we make a small adjustment. 3 months, start to raise our eyebrows a little bit. We're now through 6 months where the S&P's up 800 basis points or 8 percentage points versus the small cap 2000 is up against the S&P. That's significant. And you can't miss that kind of trade in our business. Now we have in our broad U.S. strategies some small cap and some mid cap. So we've partaken in there, but do we add there? Is it time to start shaving large cap a little bit? That's something we look at on a weekly, monthly basis. But in terms of a diversified portfolio, keeping in mind we overweight and underweight indices and sectors and industries. But from a diversified standpoint, John, first time in a long time that diversification is acting as a wind at your back, not a wind in front of you. We've been fighting any kind of diversification for a long time now.
Well, you think about it too, right? Some of it is just natural. We know how the large cap, what a springboard they had, right, in terms of outperformance. At some point, the rear end of that caterpillar starts to catch up.
Yeah. And last week I mentioned position sizing. How do you position those different indices and those different size and styles versus each other? We work on it daily. What about in individual issues? As tranquil as the broad markets have been, underneath the hood, there's been plenty of volatility. And Cumberland, in our tactical strategy, is part of that. We have a couple of holdings, one new, one a little older, that have had a ton of volatility in them. And that is AppLovin. You've heard me mention that stock. I mean, from where we bought it, it's up 100 and something percent. But intra-week, intra-month, John, that'll see 15% swings.
Yeah, absolutely.
And one of our newer holdings, Trimble, rock solid company, it's had a little bit of weakness, a little bit of volatility intraday. The reason I can live with that for now is where we have them sized as far as position versus our whole strategy.
Right.
When we're stepping in and initiating positions like Trimble, that's a 3% position. Take AppLovin. We start that as a small 3% position and make it prove to us that it's going to be a winner.
Right.
That it's going to have the possibility 3 to 5 years out at being a 2x, 3x type of investment. so far, I'm chalking this up to just volatility, not risk.
Right.
Right? We talk about that.
All the time.
Don't confuse volatility with risk. As long as growth continues to accelerate in those names, as long as their balance sheets stay rock solid, something else I look at, nobody melts share count like Trimble. Their buybacks are steady and constant. So those are some of the reasons we'll stay with those positions. The fact that we have them sized properly, and the fact that some of the outside extraordinary factors haven't changed.
Yeah.
How about in the world of bonds?
A little quieter. However, tale of two markets, right? We had Treasury yields up a little bit this week. Really 7 or 8 basis points on the shorter end, a little less on the longer end. 10-year bond went from a 4.17 to a 4.23.
Is that where it closed today? 4.23?
Yeah, around 2 o'clock. But here's the point. The numbers were good. The CPI number this week came in at 0.3 for the year, 2.7. PPI was 0.2, right on target.
Yeah.
Now that ended up 3%, not for the year, but we only have that through November because we're still digging through some of the remnants of the government shutdown there. New home sales this week, strong for December, weak for the year. So you close the year well. Next week we're going to have the PCE number, which we know the Fed looks at. My own feeling is that some of the drift up in the Treasury yields, I think, had a lot to do with the fact that you see the news out of the White House where they're trying to go after Jay Powell. We know that they have a bipartisan stand up in the Senate saying, don't do this. I think the bond market is telling you a little bit, don't do this. Because if you went back to April, when he first made noises about Jay Powell and wanting to get rid of him, the market reacted much more violently then with yields higher. So it's been going on for a while, so the reaction isn't as much, but the direction tells you that the market doesn't think much of it either. And the way you know that is you look on the muni side, which is much more dependent upon supply and demand. We have big demand, rollover at the beginning of the year. Yields there down 3 or 4 ticks. So the 10-year, 263 AAA down 4 ticks for the week. That kind of reflects the solid demand from the rollover coupon, matured bonds, called bonds. We expect that to continue for a while. So, muni market's in good shape. Treasury market's in good shape too. It's just we're going to be looking at some numbers, like I said, next week. And the more we get away from that government shutdown, the more clarity we have.
Good, Moose. Beautiful day outside, but I do have to tell you, got in my car this morning at 6:30, 43. We're babies down here.
A little chilly.
Anything under 60, I start to shiver a little bit.
Right.
43, I needed a hat and a parka.
Exactly.
Enjoy the weekend. We'll get back at it next week. Remember, Monday, the markets are closed for Martin Luther King Day. So we'll have a 4-day trading week next week.
Go Pats.